Ajay Srivastava is Managing Director at Dimensions Consulting. SV Prasad is with me right here, Chairman, Chime Consulting. Gentlemen, thanks very much. Good morning, both of you. Ajay, so this could stretch for how far you think?
I certainly don't believe it's going to go much beyond the budget, and I think could fall short. We gave a call yesterday to all customers that we need to rebalance your portfolios or sell out. We need to sell out before the budget is concerned, and if this rally continues, I think it's a... Sorry. See, we have a call yesterday that we need to sell into this rally prior to the budget. That's one. And for customers who are really not much in equity, because most of our customers are by and large at 70% debt kind of situation for the last 2-3 months. So there's some rebalancing, some incrementalism could be there. But by and large, it is a call to sell into the rally. And certainly where the banking stocks are concerned, if people are holding it, we view is that it will become a good shorting opportunity again, rather than going long into and particularly nationalized banks.
No, so you're saying this is already done. I mean, we are already, after yesterday's big monster rally, we're already stretching the limits here.
Well, central bank interventions produce all kind of euphoria. So yesterday, Japan economy contracted, but because of the central bank intervention, the market went up by 7%, and Mario Draghi came in with his own comment on negative interest rate. So, these euphorias we have seen in the past, it's a pattern, Prashant, in the last 1.5 years. Post the intervention of central bank, there is a euphoria in the market. The risk on starts for about 2 weeks or 1 week or 10 days. And then the market gradually turns down as the reality of global economy comes in. So guess we are in that partly in the euphoria of the central bank intervention, partly after such a steep fall, there has to be at some point of time, some reversal, some profit booking of shorts. So both happened simultaneously. So I don't think the rally has too many legs to go too far, but even if it does, you need to sell into it and not start to load up stocks at this point of time. Yes, selectively, or some stocks do become attractive over a period of time, but that's all about it for this rally. And you need to be prepared for, in our belief, might not be greatly positive budget. So that's where you need to rebalance your portfolios if you got stuck into it for whatever reason you were there for.
Ajay, so, how market lingo and phrases which are thrown around change very fast. So is this a bull market correction or bear market rally now?
All I know is people lose money, people make money. I don't know if it's a bull market or the bear market, and I guess a lot of people have lost lots of money in the last year on the premise that it's a correction within a bull market. Whatever it means, I don't know. I simply know
that's why the question is important to be asked, right? No, but that's why the question is important. If you believe that, okay, I'm going to be okay year to year out, because I believe that things are getting better and the overall trend is higher. I mean, so it makes a lot of difference, right? And not if you're trading and trying to punt here and there. That, of course, is not the audience I'm referring to. But people, I mean, regular people who'd like to buy stocks when they come off quite a bit.
See, you must, Prashant, our view is that contrary to the earlier paradigm of hold and keep going for 5 years, 10 years, and mutual fund will give you all kind of statistics. If you held this from 2008 lowest point to this, that's kind of fanciful statistics, that's data, that's all, nothing else. But if you look at most people, what we are recommending is this is with the volatility in the market. And why are the markets even at this level is because of huge central bank interventions. We don't know the end product of this intervention is going to be. We already seen volatility of a magnitude which we have not seen before perhaps. But our belief is that fundamentally the equity market will remain challenged for a very long time. There will be bouts of euphoria which you need to get in and cash it. And that's contrary to the long-term investment paradigm because, point to point, we believe 3 years down the line, equity returns are going to be lower than debt returns in our view. And certainly in India, where our interest costs are much higher, the government debt is priced at 7.7%, which is perhaps one of the highest in the world compared to some other economies with negative rates, like we saw Europe last week, 2 reductions in, I think, one of the European countries, if I'm not wrong, EU giving minus interest rate. Hey, you got a 7.7% gilt yield sitting right there. And 8.5% is bank bonds are going for 8.9, 8.8%. So So debt security looks to be on a longer term horizon. Consistent holding should give you better return. That's one. Number two is, even if you predicate your equity investment on a return from the market, one of the premise has to be the interest cost has to go down. If interest cost has to go down, you're going to get substantial capital gains on your debt portfolio. So whichever way you cut it, debt perhaps would give you a better return, but intermediately you'll find equity giving a handsome profit, but you got to play it smart. You can't be greedy. You got to be satisfied with smaller return, and you need to be nimble. And the long investment theory works sometimes, perhaps, and works actually most of the time. But we are in a different world.
You should lock into these 10-year fixed rate type of products. That makes sense, which offer you 7.5%. That makes sense.
Of course, for instance, in our company, we're advising most people to get into long-term commercial property deals, which give you a return of 10 to 11 or 12% long-term commitment, 6-year, 7-year commitment from developers, decent quality developers, because those are the kind of yield which you may not see. And if those yields remain in the market for an extended period of time, then the case of economic recovery also goes down. So whichever way you cut it, I think the long-term yields of 7 to 8 year periods would give you a better return perhaps as you go down the path as your financial planning tool is concerned. Equity has to be nimble, you've got to be smart and swift about it. And we have seen it, the best of the companies have had an indifferent quarters, indifferent years to perform and so on and so forth. We are not sitting on an undervalued market, Prashant. That's the basic point. Good quality stocks are priced fairly reasonably well, and that is why when you saw the correction happen, barring maybe 2 or 3 stocks like Syngene, Marico, perhaps you can count Sun Pharma into it at some point of time, barring maybe 10 stocks, nothing could stand from the onslaught in the market in the last 10 years, which tells you a story of what transpires in terms of even the stronger names today.
Yeah, no, fair enough. SV Prasad is with us here in our studios. SV, you would like to comment with some?
Fairly thought-provoking statements he has made. Some of it I agree, some of it not really. See, the investors are smart. That's why you're seeing the kind of oversubscription you're seeing in these tax-free bonds, because people know that this kind of a party is not going to last long, because after a long time, India is seeing a real interest rate scenario. That's why we have mentioned this in the past as well, Prashant. Every tax-free bond issued by the Government of India, corporations are all being lapped up and heavily oversubscribed. But having said that, I think when you compare, let's say, Europe to India, you're not comparing apples and apples, demography-wise, in terms of real GDP growth-wise, and kind of returns with, let's say, the SMEs, the smaller stocks have done, the mid caps have done, large caps, yes, they have come off, and I think that was long overdue. If you look at the last 5-year performance, large caps have given still double digit even in these markets. Therefore, I would not completely agree. Yes, you have to do stock picking, there's no question about that. Markets are very savvy, so if they like a stock, then the price discovery happens very quickly. Markets are fairly perfect in India. So I would not completely say that only look at debt and be nimble in equity, because equity means long-term investment, and whatever we may say, empirical evidence in terms of SIP, in terms of what the Sensex has given. If you take any 15-year period, you're looking at always positive, always around 13 to 15% CAGR month on month, any month you take and look at a 15-year. So therefore, I would not completely poo-poo equity, but yes, you need to be smart. You can't just kind of do a herd kind of investment mentality. So that's more my response to what you in the business as well, SV, right? Yeah.
You advise investors, clients as well. We're talking about asset allocation here.
Absolutely.
Right? We're not talking about stocks here.
Correct.
What would you recommend?
No, as far as this rally is concerned, I'm not still convinced about it. Just backing a rally based upon, what's
No, absolutely. I'm not talking about this rally as well. I'm not talking about this episode as well. From here, Ajay's point is that, this market is still not cheap. It's not as if, even after a 25% fall, we're not at a, late 2013 type of situation or 2008, sell-off after post-sell-off situation.
Certainly
all,
not.
Right?
Certainly not. Those were panic situations. If you look at 2004 when the election results went awry, you look at 2008, look at 2013, which you mentioned. So those were panic. Those are situations which are great situations for long-term equity. We are not certainly in that kind of a situation. So obviously means you need to do proper stock picking. I think the budget is going to be key as always. That's something that's going to happen. But See, I look at a lot of other things as well, Prashant. Now, for example, what Bank of Baroda has done. They have not only made a brave move of making the full provision, he's also said that the new MD CEO has said that, look, I don't want capital. This is what I'm telling the government. And March 2016 quarter is going to be a profit. Now, that's why the market has immediately responded by giving it a 20% plus thumbs up sign. So these kind of signals. So what does it also indicate is that do you need these kind of professionalization of senior management in other PSUs as well? We only talk about privatization of PSUs. Why not professionalization of that's one.
Do you believe, my question, is it a bull market correction or a bear market rally? What do you think?
I would think it's a bull market correction. Honestly, I think it's still long term. India is very much a secular bull story, whether it's a UPA or NDA or whatever. There's no question about demographics, the way the economy is growing. It's largely it's still a consumer-driven story, Yes, exported.
Just one point, SP. What I'm hearing from serious market participants is that the fact that they're talking about this stuff, brought this to attention. This entire capital gains issue. I don't know if you've read it in newspapers, etc. The fact that there is a thinking that the exemption from capital gains on stocks, for which the threshold is 1 year, they're thinking of making the threshold 3 years, from 1 year 3 years. Got to hold stocks for 3 years before you can get the exemption. I spoke with Jyotivardhan Jaipuria, for example, and he said he's been speaking to fund guys, etc. And it's not fully a credible concern, but it is coming up in conversations, etc. What do you think, SP? You think something like this will be done?
I hope not, because the timing is completely all right. I think this would be the wrong time to do it because completely wrong time in terms of market being choppy, in terms of general. The first year, the honeymoon period, maybe they could have got away with it when the government came to power.
The point is, why would they want to do it? I mean, they've been talking about increasing financialization and getting stocks from hard assets into markets and all of that stuff. Anyway, Ajay, any thoughts on this entire capital gains bit?
Yeah, I think, Prashant, see, this runs counterintuitive to the theory of equity investing, which is supposed to be a longer term investment. So therefore, I don't think there is an argument to say that 1 year is a good time frame, because everybody on the panel, including Mr. Prasad, said correctly that we need to hold for longer term. Therefore, the concept that equity long-term capital gains should be tax exempt for 1 year, I don't think so. Making it 3 years is going to affect it too much in terms of people's pattern of investment or the market. Yeah, emotionally you can say why we're doing this 3 years, but I think that's not the issue. The issue is that your domestic investor is holding up this market, including yesterday. Yesterday was notable, the day of reversal. FIs still sold yesterday. While you're quoting FIs and giving them tax-free treatment on every transaction, the Indian public, which is holding the market together, is being taxed differentially and adversely. Is that a fair and a good policy? 1 to 3, I don't think so. I don't think they should bother anybody at all in equity markets by and large. But the fact that you have such a large differential now already existing and you're going to make it larger with the domestic investor versus foreign investors, is that a fair proposition for a country? That's the question. 1 to 3 years, nobody can argue it, because all the mutual fund guys say you got to hold it for 5 years, 7 years, 10 years, and so on. So the government will say, you are the guys who said hold for 5 years. So what am I asking people to do for 3 years? What's the big deal? That's one. Number two is there has been a lot of misuse of provision of 1 year by bonus stripping, in mutual fund dividend declarations, etc., and so on and so forth. So I think there is a logical basis of making it 3 years. There is no conceptual standpoint. I agree with Mr. Prasad. The timing may not be the best of it, but it should impact the equity market. I think what should worry the equity market is how long will the differential between foreign investor and local investor continue, because that encourages people to take the money out and bring it back. And that, I think, is something which government policy should look at.
The basic difference,
1 to
Ajay,
3 is,
for our viewers,
not a big issue.
For our viewers, would you explain what's the basic difference? I mean, the differential treatment in terms of tax for local and foreign investors. Yes.
Yeah. See, what is happening in India is two things are happening. One, you have a short-term capital gain before 1 year, and second is a long-term capital gain 1 year. Even for regular market participants, even though you hold, one is that you need to pay short-term capital gains tax of 20%. That's one. Okay. The foreign investor, when it comes to the tax treatment countries like Mauritius, Singapore, etc., does not pay any tax on any transactions. On the head, what's happened in India is there's a huge amount of IT litigation on, where if an individual or a company has done numerous transactions, The tax authorities have taken it as a business income and taxed it at 30%, irrespective of whether it's a long-term or a short-term capital gain. So lots of market participants who deal actively in the market are right now having a litigation with tax department, paying a tax of 30%, even though 90% of their income could have come from long-term capital gains and only 10% from short-term capital gains. So this is a phenomenon which is taking place. Unlike an FI or a foreign investor who does not face this at all and has a tax-free treatment through and through, even if he's holding it for a day.
Fair enough. SP, you want to comment?
The only quick thing on that is that, I think it's more a question of, the administration, the IT administration, income tax administration, which is the issue out here. On one point, I completely agree with him that on short-term capital gain, it's not a level playing field. But as far as long, because they come through this Mauritius and other tax haven routes and they don't pay that as well. But on a long-term capital gain basis, this is more IT administration issue, frankly. And I appreciate his point. It's a big issue, but it's not to do with the law per se. That's what I would like. As far as FI is concerned, of course, the other challenge they had was MAT. I think that's getting sorted out. So if you ask me honestly, after a long time, Prashant, I've been very happy that from 2015 onwards, the domestic investors are putting in a lot more money than FIs, which is always the case in most large markets. India was an exception.
It's starting to turn. We might be talking after the fact, right? Because, in January, it was the lowest since this government took charge. Some $450 million came in.
True.
350 out of the 450 was SIPs. So actual discretionary lump sum investments into equity from local guys, retail guys, has actually gone down to the lowest point over the last 2 years. We don't know what the number for February will be. So it's already starting to, maybe it is already turned. February will be important to note as well. And the point is, mutual funds buy when they get cash, right? If they don't get cash, they don't buy.
Right.
So it's as simple as that. So we'll have to, and I was hearing over last week that some certain schemes, etc., are getting redemptions. Local funds are getting redemptions, etc., as well. So that's another point altogether. Just a quick point, Ajay. Any what are you doing apart from not everyone can invest in commercial real estate. So, what should the ordinary folk do?
See, as I said, it's a question of how much are you invested into the market and what's your present status. So there's no one remedy or one solution to everybody. Most of our customers, as I said, are 25 to 30% in equities. We give them the freedom to go and out and experiment and take larger risks when a correction happens. But if you are already at 70, 80%, your maneuvering has got much less. But what we have done is, as I said, this is a time to rebalance your portfolio. This is a time to look for some of the stronger names in certain industries. And I still say, in spite of all the downturn, I would still put pharma as one of the guys which I want to put the money in. We are buying construction companies at this point of time. We have bought lots of MNC companies, sector agnostic, because we expect some corporate action to come there. There are, as I said, few good Indian companies on the radar, but we find it too expensive. We like iShares, but the growth is plateauing out and the PE is 50. We like Marico, but the PEs just are prohibitive. If you look at Page Industries, beautiful business model, fantastic product, but look at the PEs they're commanding it. Look at Ashok Leyland, nice company, may give still returns. PEs are, astronomically high for a value buying. So we are sticking to the portfolios at this point of time and saying, selectively, we will buy construction, we will buy pharma, we will buy the MNC companies across sectors, and there are few, about 10 or 15 companies we'd keep buying at any point of time where there will be action. For instance, liquor companies which are so enormously cash rich overseas will eventually pick up the Indian company and make them subsidiaries. So you got to take a longer term play with them, but every correction gives you a chance to add up to your portfolio of these companies because they will get bought and they get very handsome premiums. So I think this is the way we are spreading out our market risk at this point in time. We are keeping away from BFSI. In fact, our call is that if there is in fact, we're talking of Bank of Baroda, it's on our short list at this point of time because no matter what you spin the story at, the reality is it's a bank in trouble with a 52% coverage. You can say, I will do 20%. What is 20% growth in next year loans? The industry, the economy is doing 5%. They want to do 20%. HDFC Bank can't do 20%, but that bank will do 20%. Give me a break, guys. This is where I think you're important to identify what is market clatter and what is going to be reality. You remember when the appointment took place, the Bank of Baroda share went to 230. It climbed 15 to 20% in 2 days. Look at the share price today. I am telling you, you look at the performance 1 year down the line and we'll discuss the share price again.
You know, Ajay, I've known you to stand away from the crowd for a long, long time over the years that we've been chatting, but now you've gone full renegade. Just joking, but I love it. Great chatting with you, and
I need to put my Rambo thing on, right?
No, don't do that. Huh? With the
we are shorting
environment
Bank of
we have in
Baroda. If
Delhi.
rate increase, we will short Bank of Baroda. It's an open disclosure.